Hello and welcome to Econoday Unplugged on Tuesday, the 21st of January 2020. Mark Pender is across the pond stateside and I'm Jeremy Hawkins here in London. So for history lovers, it's 12 years to the day since the Black Monday of 2008 when stock markets around the world plummeted on the back of worries about what turned out to be the global financial crisis. Not so now, of course, with many benchmark indices at or close to all-time peaks and investor sentiment underpinned by record low interest rates and, as of last week, buoyed by the latest signing of the phase one of the US-China trade deal. But just yesterday, the IMF trimmed its world growth forecast by a tick to 3.3% this year and by 2 ticks to 3.4% in 2021. It also noted that the balance of risk to the global outlook remains on the downside, albeit less marked than in December. Also of note, there was a significant deterioration in optimism in PricewaterhouseCoopers' annual global CEO survey, which is quite widely respected. This is their 23rd edition of this. Found only 27% of CEOs very confident about prospects for revenue growth in 2020. And that's the lowest level of this particular report since 2009. Well, both sides can't be right. So, Mark, ahead of next week's FOMC meeting, and with a Fed that these days clearly pays a lot of attention to global economic developments, how do you think the international economy might influence its thinking?
Well, I think the phase one deal is, for right now, probably a big deal. It's going to be at least a big enough deal for them to wait and see if there will be a recovery in global cross-border trade. So I think that is a positive to begin the year. And however, the actual economic data that's been coming out has been slowing. We can go back to the December employment report earlier, and just this last week we had a JOLTS report. Job openings in that report were very soft, down to 6.8 million. That's about 500,000 or more from their peak. And that was more than a year ago, and the trend is definitely coming back. So there's fewer job openings, which means kind of a much less chance for having any kind of wage growth, which is already slumped. And that was actually one of the biggest factors of the December employment report. So I think that they're going to definitely be in the wait and see mode, and they're not going to be in any hurry to change their policy at all. And like I say, I think the trade deal is, it will, these constant drumbeat of the trade tensions. Is it possible now that after a couple of years of this, that's going to fade? And that may have might give a lift to business sentiment.
Yeah, it's going to be interesting. I think you're right on this trade stuff, because this is just for phase one, isn't it? Which is really just sort of scratching the surface. There's still the whole of whatever phase two might look like to be sorted out. And I think there's already been talk that it may be the case that China won't see all the tariffs being removed, or whatever it may be. So it does seem as if trade's going to remain very much in sort of central bank and investor focus as we go during this year. But I find it quite interesting that we've had all this from the way the stock market are trading, and there appears to be just so much optimism there. And yet, when you get to some of these surveys, and there's been some more bits and pieces coming out of the Davos, the World Economic Forum, which kicked off this week. Some of the CEOs there, they don't seem to be expressing the same kind of confidence about the business outlook from their side of the operations that the investors themselves are when you look at the current level of the stock market. So it's going to be interesting to see who's right and who's wrong in this one.
Well, that kind of reflects the economic data, that we cover. It really hasn't shown much lift at all. But, the stock market are famous for, anticipating the future, I guess, and they're maybe over-anticipating strength. But certainly if it's based on central bank policy, which has been very accommodative, more and more accommodative, then I think that's the driving force behind the financial markets. But it'll take a little bit of a while to see the impact of these, and that's another factor that'll keep the Fed on the sidelines as well, is waiting to see what their 3 rate cuts the second half of last year, waiting for that to start gaining traction.
Yeah, interesting fact of the day, well, this was to me anyway, looking at this new IMF survey. Apparently they reckon we had the best part of 70 interest rate cuts by 49 central banks in 2019.
Wow.
And they reckon the interesting figure here, and I think clearly this is an IMF estimate, but they reckon global growth would have been half a percentage point less but for that action. So again, it raises the question now, that's with all those interest rates having taken place, raising growth 0.5% above where it would have been otherwise. And we're all kind of admitting now that there ain't that much more room on the downside for interest rates to go. So if we were to have to try and boost the economy this year, where's the stimulus going to come from?
Well, now, what was the final number? Was it 2.9% for global growth last year? Did you see that number?
I think it was 2.9, something like that, yeah.
And so it would have been in the mid-3 range had it not been for the central bank, according to the IMF estimate.
Yeah, that's right.
And what did they see for 2020?
2020 as of yesterday when they released their new forecast, it was 3.3% in 2020 and 3.4% in 2021.
So they do see it coming back up then.
They do, although, of course, historically speaking, those kind of rates are nothing to write home about. And they also talk about a lot of this really coming out of what they expect to be happening in emerging markets, where they're looking for a general rebound there. But also when they talk about the risks, and we talked about this before, it's rising geopolitical tensions, which I think they work out as being the biggest threat to growth actually starting to recover as we go forward. Of course, in some of these emerging markets, obviously we put the lights over India in there, Hong Kong in there, where these risks are most apparent in the first place. So it makes for plenty of volatility, or should do. Lack of volatility, well, that's going to be the ECB. And of course, we get, while we're talking about central banks, ECB meeting on Thursday. Well, to all intents and purposes, no change there in terms of interest rates, and quantitative easing is pretty well a done deal. But it's going to be, and I'd say it's a bit of an outlier here, but I think it's worthwhile people just keep an eye on. As things currently stand, and indeed has been the case for some while now, the ECB still has what calling it a downside risk to its economic projections. So it's downside bias to its risk assessment. There has been, though, a number of comments coming out from ECB members really since the last meeting, 6 weeks or so ago now, suggesting that the economic data coming out of Europe is looking a little bit better. Not great by any means, but at least the slowdown perhaps is coming to an end now. If that is the case, next stage could be a move higher. And bear in mind, of course, that we know that there's at least a number of governing council members who aren't happy with the current level of interest rates. They didn't want to see the September cut in the deposit rate. They didn't want to see quantitative easing being restarted. So if they were to shift that bias from downside just to neutral, which is no great move, but it could be a way of placating the hawks, and at the same time, without actually tightening policy, just sending out a kind of a confidence message to investors and financial markets that things are looking a little bit better. It may be too early to make that kind of call, but I think it's something worthwhile keeping an eye on.
Well, tell us how they make that call within the statement. Was that something that you will see immediately at release time?
I suspect not. You'll probably only see it when we get to Christine Lagarde's press conference, when she actually reads out the full thing, and then we'll talk about the economic risks are.
Wow.
So you'll probably have to wait for the conference.
So the big market mover could be hidden in there. Wow. Okay.
Could well be, yeah. Okay. It's certainly something to keep an eye on, I think.
Well, tell us about the data out of Germany, the sentiment data that we saw today. That seemed to fit into what you were talking about. A big spike higher, right?
It is. I mean, this is the survey from the ZEW guys. It's a private sector survey, and I suppose you might say, if you want to be negative about this thing, it's a survey of analysts. So you either believe them or you don't. But they saw a fairly sharp improvement in. They take a gauge of current conditions and a measure of expectations of analysts, and they both show significant improvements. And this is for the third or fourth month running, depending upon which particular measure you use. So it does seem that, the confidence numbers in Germany at least are starting to move a little bit higher, or at least the forecasters and the analysts are starting to think that, well, perhaps now fourth quarter ain't going to look good in Germany. We know that, but there's the chance perhaps that we're going to see the first quarter and the rest of this year starting to see some kind of improvement. But I think a lot of that is going to hinge upon what happens to the manufacturing sector. We know that, as we talked about so many times in the past, German manufacturing is in deep recession at the moment. We don't have the full fourth quarter numbers yet, but it would take something of a small miracle, I think, to pull it out of recession by December of last year. And I think, again, it comes back to almost, this the opening spiel about what's going on with global trade and so on. Germany is very susceptible to swings in global trade. And I think, it's this phase one agreement between the US and China. People are viewing that as potentially a platform for a more general improvement in global export and import conditions, which would disproportionately help Germany. Were that not to happen, of course, then things could start getting quite nasty again. So
I'm sorry, but can we shift gears now to what might be the big story of the month, and that's the Bank of England meeting. We'll not looking past the ECB this week, and maybe we can look past the FOMC a week from Wednesday. But on Thursday, we're going to get that Bank of England statement. And we had the labor market report today out of the UK. If you could help explain how to read that labor market report, it would be a big help for me.
Right. Okay. Well, let's just put the labour market report in context first, because you mentioned the Bank of England, which for many a month now has really just been a tiny dot on investor radars because they've been so constrained by Brexit uncertainty and everything else. That everyone knew that the bank wouldn't do anything with interest rates. All of a sudden, just putting the labour market report on one side at the moment, we've had a string of really pretty terrible numbers coming out of the UK. So we saw a big decline, unexpected decline in retail sales in December. These are in volumes. It was down 0.6% on the month. And that's the fourth decline in the last 5 months. We saw a contraction in November GDP, which certainly wasn't expected. And it's shaping up now as if there's a real chance we could actually see a contraction in total GDP for the fourth quarter itself. And just to rub salt into the wound for the Bank of England, the December inflation report, that put headline inflation, so the annual change in the CPI, at just 1.3%. So that's 0.7 percentage points below its 2% medium-term target. And that's its lowest reading since November 2017. And at least as important, the core rate, which strips out the usual volatile elements, well, that's just 1.5%. And that's been sub 2% now since August 2018. So the bottom line is that if we go back, about a month or so, markets attached about a 5% chance, if that, of a cut in interest rates at next week's Bank of England meeting. As a result of these numbers, and as of yesterday, that probability was up to about 70 to 75%.
So from 5% to 75%?
Yeah, literally, it completely turned the corners from what the futures markets are discounting. Now, going to your question, now I finished the pre-ramble. That probability has now come down again. It's still setting just how much is hard to say at the moment, probably to around about 60%. And that reflects the fact that the UK labour market, despite the weakness I've been talking about, actually held up quite well in the November-December report. It's a bit mixed for the UK. On some measures like the claimant count, which measures the actual claimant count itself in any particular month for December.
And those are people who are unemployed.
Yeah, and these are actually claiming unemployment benefit. Now, these figures are being downgraded by the National Statistics Office, and they're not wholly reliable due to some changes in the series. But because they're more up to date than anything else we get, markets still tend to look at them quite closely. And they showed an increase of about 15,000, which is in line with the previous month and suggests that the market is weakening but not doing too much. However, the International Labour Office statistics, which are the ones which are comparable with what we see coming out the rest of the Eurozone, they showed on the employment side an increase of 208,000 in the 3 months to November. So this is lagging a month and it's measured over a quarterly period. But that is a big increase, and it led to a record number of people in employment and a record number for the employment rate itself. So in other words, as ever, quite often with these things, you get conflicting views about what it means. But strict taken literally, it suggests that despite the slowdown in the real economy, the labour market from the pure employment figures is still doing very well. But adding sort of just fuel to the fire for those people who think there should be a rate cut. On the average earnings side, so for people who are used to looking at the US employment report and the wages side of that, average earnings in the UK, that's held steady at 3.2%, and it dipped to 3.4% from 3.5% once we look at regular earnings, which excludes bonuses. Now, this compares with numbers knocking on 4% round about the middle of the year. And it was round about the middle of the year when markets were starting to think, well, perhaps the bank might have to tighten after Brexit. Depends how Brexit comes about. But these figures suggest a bit like, as we're seeing on your side, I suppose, almost irrespective of how the real economy is doing, and by and large, I think the fourth quarter for UK, irrespective of today's numbers, is shaping up pretty poorly. Now, inflationary pressures continue to gradually dissipate. So I think for those people who wanted to see interest rates cut in December, and there are 2 MPC members who dissented at that time, it may well be the case that the balance of evidence at the moment, is kind of going to push more people into that camp. Into the easing camp. Now, what is going to be important, I think, and people should really be aware of this, is that the Bank of England's central case call has been for a long time now that once Brexit is sorted, and their assumption on Brexit was that there would be a trade deal, and crucially there would be some kind of subsequent bounce because of that once the election was out the way, to give to lift consumer spending and business activity. They expected that to wipe out what is already quite a small output gap and put upside pressure on inflation. However, it seems from all the comments we've had coming out the Bank of England over the last 2 to 3 weeks that they're no longer confident this bounce is going to come about. They have regional agents which provide them with internal data which we don't get to see. And it seems from their commentary that some of these reports simply aren't looking that good. And if we're not going to get this bounce, then all of a sudden, the reasons for tightening go out the window. And because the current data we do have has been so poor, are they going to come out and cut interest rates? So it does mean that we've got some hugely important numbers between now and next Thursday for the Bank of England. And particularly...
So are you saying it's possible that they could cut rates next week?
Yes, I am. I'm not totally convinced yet, but I personally, I'll say at the moment, there's at least a 40% chance of it.
But don't they have to move? They're already tightening. Don't they have to have some kind of a transition to tell us that they're going to move to neutral?
Well, no. I mean, effectively, the tightening came as part of their central case scenario. And although it's got to be said at the moment, their central case economic scenario regarding Brexit appears to be coming true, the rest of their economic forecast look as if they were simply too optimistic. But now the problem is, we talked about the general election, the Brexit uncertainty, and so on. They were looking for what markets now calling the Boris bounce, the Boris Johnson bounce, having won the election so clearly, etc., etc. But the figures we have at the moment in terms of the hard data don't really encapsulate that time after the election, at least not enough of it to fully reflect it. But what we will get this Friday is going to be this new composite flash PMI for the UK, which, just like we see for the Eurozone, it's only been going for 2 or 3 months now. Markets are still getting used to it. But it's for flash index of the markets estimate effectively of UK GDP. So we'll get this out on Friday, and it will really give us one of the first indications as to whether or not activity rates have responded to the general election and what will be now Brexit at the end of this month. Before then, we'll also get the Confederation of British Industry Trend Survey, which again will be for January. That's on Wednesday. And next week, we'll get the CBI's Distributive Trade Survey. That'll also be for January.
So these are business surveys you're looking at. It's not going to be definitive data. But I'm just looking at the consensus now for Friday's composite flash, and it looks positive, led by a significant improvement in services, from a little contraction to a little expansion, but still contraction for manufacturing. If it does come in those, how do you think the markets would react?
Well, I think at the end of the day, we've got to go by what the consensus says, and if for the composite index, if it's stronger than the composite index, we'll probably see the pound rally. If it's weaker, we're going to see the pound fall because it's going to increase expectations about a possible rate cut. But I think it's worthwhile saying that when we get these flash PMI figures, the markets, to be honest, don't really have much of a feel for it. There's very little you can actually use to try and construct the data yourself, and it's these flash indices themselves which tend to be used more with a view to calling the hard data as and when they arrive in a few weeks later, which means that misses on the flash PMIs can actually be quite wide, and indeed often are.
Well, let's go back to the ILO. You had a 200,000 3-month growth in
full employment.
So that's 60,000-70,000 a month.
Yeah,
and so that's quite high.
That is a very decent number,
and that's a definitive number.
And that's supposing until it gets revised. Yes, that's a hard number.
And you can cut rates with into the teeth of that.
Well, if you can you can justify, I suppose, because if you look at the reason for the Bank of England talking about tightening was that the labour market is going to, it's getting tighter and tighter. The output gap will close. Wages are going to rise as a result. And that's going to, as we all know, should know, not necessarily works anymore. As wages go up, you expect inflation to rise at some point in the future as well. However, as today's numbers suggest, and the last several months' figures have suggest, it doesn't seem to matter too much what the labour market's doing at the moment. Wages growth is still slowing. So it seems that people coming into the labour force are being paid at the lower end of the spectrum, and so it's dragging down average annual wages growth. And if wages are slowing, and we've already got inflation so far below target now that it's starting to get embarrassing for the bank, there's going to be certainly some members on that MPC. I'll guarantee at least 2 will vote for a cut next week. We know that Haskell and Saunders, who voted twice now for a cut, they're guaranteed to vote again for it. It's just a case of whether or not the inflation numbers and the wages numbers are going to be enough for other people to think, well, look, just as some kind of insurance cut, we can do the same thing.
Did the pound react today? Have you had a chance to look?
The pound certainly came off initially on the back of it. But since then, it's actually started to creep up a little bit because we've seen a slightly weaker euro. This is looking at sterling euro here. But I think it's interesting looking at from the way the futures markets are trading now. It's going to be interesting next Thursday. From being a month ago, think, well, what can I write about the Bank of England meeting because there's nothing more to say. Now it's going to be, as you said, it's going to be a major focal point for next week now because it's a central bank which could well change, having seemingly no chance of that whatsoever for a long while.
And so your key for this week is Friday's PMI composite flash out of the UK. It's going to come out at 9:30 your time?
That's 9:30 London time.
And let me just see, the consensus is 50.2 and the month ago was 48.5. So something that's disappointing. It could have an immediate impact on expectations for the.
I think so. If it comes in below 50, then clearly, by definition, we're sort of talking contraction territory.
Well, that's a big jump that they're really expecting. Usually, PMIs, they move very slowly.
It is. Yeah, you're right, and it may well be. Markets were taking the Bank of England, its original world, and think, well, the bank expected a bounce, the Boris bounce to be realised, so we'll go along with it. But it may be that perhaps that's wrong, and we could see a big undershoot.
So the forecasters, I see. Okay, so they're incorporating the Bank of England's.
I guess so. Yeah, but the bank itself seems to be backing away from that. So, interesting times for the Bank of England. Just out of interest, makes it even more interesting. Of course, this will be Mark Carney's last BoE meeting, or MPC meeting, I should say, as governor of the bank, since he will be off in a new role as of the beginning of next month. Okay, well, we've been talking for a long time. So let's just wrap this up very quickly. On the central bank side, Bank of Japan earlier today announced no change to its stance. So it's still trying to control the yield curve. So the target for the overnight rate remains at minus 0.1%. And it's still looking to keep 10-year JGB yields around about the 0% mark. Bank of Canada, they will be announcing this Wednesday, so a day before the ECB. Markets there not looking for any change in interest rates. Not so long ago, there was talk that, well, look, the BOC is going to have to cut because it's got to keep up with all the other central banks. But by and large, the economy has been doing better than many others. And certainly as far as the governor's concerned, he seems to think there's not a lot of output gap left there. And even though manufacturing and investment aren't doing too well, the new consumer survey, which the Bank of Canada introduced, I think it was last week, suggests that by and large consumers are still holding up pretty well. So no change out the Bank of Canada. Okay, we done. I think we probably ought to be, shouldn't we, before people start nodding off.
That was a lot. That was a lot.
Yeah, that was a lot. Yeah, sorry about that, folks. We'll try to keep it shorter next time. So then, that is it then for now. But remember, Econoday's global economic calendar will keep you up to date with the all-important goings-on until we reconvene next week. In the meantime, thanks very much for listening, as always, and we'll see you next time. Bye for now.